How to get financing to flip a house. Everyone says you need money to make money. That's wrong. You need the right kind of financing. Banks hate flippers, but I'll show you where to actually get the money. In this video, I'm going to break down the 3 main ways to finance your flip, even if you've never done one before. By the end, you're going to know how to fund a flip without having to beg the bank or without having to drain your savings. The good news is you already know how to do this. Let me ask you a question. Have you ever bought a house and took a loan out for it? Probably didn't pay cash for your house, right? How about your car? If you didn't pay cash for your car, you took out a loan to buy your car. Even using a credit card, all these things you're using what? OPM or other people's money to make your purchase, and then you pay payments to someone else because you borrowed that money. It's no different when you go into real estate investing. The cool part about real estate investing is there are so many more options because it's a hard asset. People are willing to loan on this investment because it's a hard asset they're protected by. A lender is protected by a note and a mortgage, which means if you don't make the payments, they could take that property back. They use the property as collateral. They're also covered by insurance, which is not true of many other investments. If something catastrophic were to happen to the property, the lenders are protected by an insurance policy, so they would get their money back. So they're being so secure, why won't traditional banks lend on flips? Traditional banks make their money on long-term loans. They make it by compounded interest over 20 or 30 years. That's where they make their money. So they really have no interest in dabbling in short-term loans for flippers. Because even though the interest rates sound higher with a hard money lender, you're actually paying less money because it's a short amount of time that you're borrowing the money for. So banks really have no interest in being in that business. So you will find that they are not helpful in any way, shape, or form. The only thing a bank might do is loan you on the purchase price of the property. But they really don't want to get involved with the renovation costs at all. So you have to change your gears and say, where do I get the money from? And I'm going to suggest that you get your money from what's called a hard money lender. Hard money lenders are very simply a group of people that will pool their money and they will loan at a higher risk because it's a higher risk for them to loan to a home flipper. So they'll get higher returns, again, risk versus reward. So they might get 10%, 12%, 15%. If you have bad credit, maybe 16 or 18%. But that's the cost of doing business to get money to flip a house. But these people will loan you money on the property. Again, they're called hard money lenders. It sounds way worse than it is. It's not like Guido the Killer Pimp that came along back in the 80s, right? That's not what it was. So it's just people that get together and say, we're willing to loan money at a higher risk because we want to get a higher return on our money. Now that being said, how do they loan money? Well, they will typically loan around 80% of the purchase price of the property. So if the purchase price for easy math was $100,000, they're going to loan you $80,000 in that property. Now that leaves $20,000. I'm going to cover that in just a minute. But remember, that's going to be what's left over that you have to come up with. But you don't have to use your own money. Stay tuned. Next, they will usually loan you up to 100% of the renovation costs of your property. Now, the cool part about it is this is where traditional banks will not help you because this is the riskier part for an investor. They're going to loan you money to get the renovation costs done, and truthfully, the property may not be worth full value until you get all those renovations done. So that's why it's a little riskier for them. What they usually do is pay you in draws. So let's say you broke down your construction into 5 different phases. And as soon as you get phase 1 done, you have to pay the contractor, and then they will reimburse you for the money you just paid the contractor, unless you can find a contractor willing to wait a week for their payment, which is not always easy, but you can do it. So that's how you finance with a hard money lender. Now you say, Glenn, you just left me with $20,000 on the table, bro. How do I get through the $20,000, right? I don't want to drain my own savings for this. Now you can, but you don't necessarily have to. For that other $20,000 we just talked about, by the way, that's called gap funding, right? That's the gap that's left over. I'm going to suggest that you use a private money lender. What's a private money lender? It's someone that you know. It's a family, it's a friend of family. It's in your network of people, someone that's willing to loan you that $20,000 so that you can finish that project. And so you're going to pay them 10 to 15% on their money. And by doing that, you can actually start to build a private lender base because once somebody loans you a little bit of money, you get done and then pay them back. Do you know that if they have more money, they're going to start finding ways to loan you more money because they want to get more money on their money. So it's a great way to dip your toe in the private lender world by using them just to cover your gap funding. If you do that, you now have 100% financing. But let me take it a step further with you. You're going to have some cash flow issues if you're tight on cash. So if you don't have a big savings account and you're kind of living paycheck to paycheck, you have a great job, but you're like, I don't want to be in a tough situation. There are payments that are going to happen during your flip. So for instance, you're going to have to make interest payments to the initial hard money lender. They want interest payments. You may have to front the contractor payments up front for a week before the hard money lender reimburses you for that money. And there's going to be miscellaneous materials that have to be purchased and miscellaneous contractors and things that have to be done that's going to require cash out of your pocket. The first thing I want you to do to cover that $20,000 gap we just talked about is look inward. Do you have other areas in your life that you have access to money that's not your money? Do you have a HELOC or a home equity line of credit you could just tap into for this? Do you have a 401k you could borrow against? Did you know that your employer will let you borrow up to $50,000 in a short-term loan off your 401k? How about an IRA you could borrow against? How about a whole life policy that has a cash value that you could borrow against? How about stock investments you could borrow against? How about some other asset you could borrow against? You see, there's a lot of ways you probably have access to money. You could even use credit cards, and if you were clever about it, you could use 0% credit cards and take a cash advance if the amount was small enough to fit on credit cards. So that's number one. Number two is, what I suggest is, from your private money lender, you can actually borrow more money. So let's say instead of borrowing $20,000, you borrow $30,000, and now you can go through with your flip and not have to worry about having cash flow problems. Now, these private lenders may not realize that they have access to money too. You may have to educate them by saying, hey, do you have a HELOC? Do you have credit cards? Do you have a way to borrow against your 401k? Because if they do, they could actually make money by borrowing money from someone else. If you're going to pay them 12 or 15% and they're going to borrow money off of their 401k at 4%, they're going to make 10 or 11% on money that's not even their money. So it's a win, win, win all the way around. You just have to know how to do it and be clever with the financing. And another way you can finance your deals is to be creative. This is called creative financing. Here's a way you could do creative financing. Let's say that you meet a seller and a seller says, I'm willing to take $100,000 for the house. And you look at your records and say, well, I don't have $100,000, but I want to make this deal work. Maybe you have $50,000 set aside. Maybe you have a HELOC to do the renovations, and you say, I don't have enough to buy it, but let me see what I can do. You go to the seller and say, Mr. Seller, let me ask you a question. I do want to give you your $100,000. Okay, I'm willing to give you your number, but I want to give it to you in 6 months after I flip this house. So hear me out. We'll go into this transaction together. We'll write up all the paperwork. Essentially, you have the owner become the bank. You say, look, I'd like you to just let me pay you that $100,000 in 6 months as soon as I flip this house and sell it. There'll be paperwork that protects you so that you know that you're going to get paid. You're the first one to get paid when I sell this house. Would that be acceptable to you? Now, not every seller is going to say yes. Would 1 out of 10 say yes? Maybe. You just have to ask. And when you find sellers that do that, now you don't have to put any money down to buy the house because the seller becomes the bank. And when you fix the house and renovate it with your HELOC or whatever money you have, or maybe you get a private money lender for that, well, guess what? You've now flipped that house without using any money of your own. The bottom line when it comes to financing a house is you don't have to go through a lender necessarily. If you've got challenged credit and life is tough and you're trying to figure out how to do it, or you don't have any friends that want to loan you any money, you know what? There are ways to get this done. You just got to be creative and think outside the box. If you want more creative ways to do it, make sure you look and subscribe to our channel. We have a lot of ways you can get these deals financed. Again, it's not a matter of how much money you have, it's how creative you can be and how many ways you know to use other people's money to finance your deals. Financing is useless if you don't know what deal you're trying to fund. That's why your buy box matters. Go watch the next video, the crucial step that most new investors always miss, where I'm going to show you step by step how to focus on your strategy, how to build your buy box so that lenders will be banging down the door to give you money for your deals.